Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday.
This week, we're going to do an analysis having a look at market returns in the US, this time around relative to the Gulf War, and we'll show signs that the economy this time around is in much better shape. We'll have a look at the non-farm payrolls data in the US as an example. We'll also have a look at the earnings data in the US, and we'll also have a look at earnings data across the globe. We're going to start off with the latest out of Iran. As we saw over the weekend, Iran had responded to the US proposal, and President Trump had declared that the Iranian response was totally unacceptable. We can see in the betting market at the moment the likelihood of the Strait of Hormuz being completely open by the end of June is quite small. At the moment, the betting market is pricing in about a 40% chance that the Strait is opened at that point. And that does raise some risk. Globally, we are running low in inventories, and at some point we could land up with a sizable price shock. But it's not completely in the market. That is not the market's base case at this point. And we can see that there is some degree of resilience in global equities, if not actually strength. And we can see that as an example by comparing the performance of the S&P 500 and crude this time around relative to what happened in 1990. And we can see as an example that crude, while it has increased materially, hasn't increased by as much as it did back then. In addition, if you look at the S&P 500, the S&P 500 this time around has been quite strong. In 1990, it drew down, as it has in all the other oil crises that we've had a look at. And there are a number of differences between what's happening at the moment and prior oil crises. But the underlying thread is that the US and global economy is proving to be quite resilient. And we can see it in a number of different metrics. We're going to look at the non-farm payrolls this time around as an example. Now, the non-farm payrolls numbers did come out last week. They surprised on the upside. 115,000 jobs added last month. The consensus was 65,000. And if you scratch a little bit, it is showing remarkable resilience in the US labor market, despite the fact that the US government is shedding jobs. If you look at the number of people employed by the federal government in the US, that number is the lowest it has been since the 60s. So the US government is shedding jobs, but the private sector is adding jobs. And if you look at a number of indicators to look at the strength of the US market, the US labor market, and we look at a few, as an example, you can look at the number of quits in the US. Typically, quits decline in a weakening labor market. People are less confident about quitting their job and getting another job somewhere else. And quits seem to have plateaued. And if you look at the 3-month average of non-farm payrolls, and bear in mind that the non-farm payroll series is pretty volatile, so it's best to look at some form of moving average, and we prefer to look at a 3-month average. That 3-month average picked up materially relative to where it was at the end of 2025. And if you look at the unemployment rate that's sitting at 4.3% is actually a bit lower than it was at the back end of last year at 4.5%. So there's a range of indicators to suggest that the US labor market, in fact, has turned. Now, we do need to wait a couple of months to be absolutely sure of this because the data has been revised quite materially over the past couple of years or so. So let's just wait a bit. But the early indicators suggest that there's a degree of resilience in the US labor market. And it's not just the labor market, it's not just the US. I mean, if you look at PMIs as an example, the PMI data is pretty strong. The latest global PMI series, it suggests that global growth expanded last month, believe it or not. That series was sitting at 51.8, up slightly on where it was before. And bear in mind that a PMI series is the most timeous indicator of economic growth. And when the series picks up, it typically corresponds and correlates quite strongly with faster GDP growth. So we're seeing a labor market in the US which is pretty resilient, and we're seeing a global economy at this point which is looking to be pretty resilient too. And if you look beneath the surface, what's been reported by companies has been pretty good as well. We're about 90% of the way through the US reporting season for the S&P 500. And of those companies that have reported, over 80% have beaten on the earnings line. And earnings growth at the moment in the US is looking to be close to 30% year on year. Now, if you strip out some once-off items in some of the Mag 7 companies, you're still getting an earnings growth rate of sort of mid-teens, which is pretty good year on year for Q1. And if you look for the full calendar year, for the US this year, when you look at what's currently expected, the current consensus forecast is that earnings this full calendar year will be more than 20% above earnings last calendar year, which is an impressive number, especially when you consider what's happening across the globe and what's happening in particular with regards to global energy markets. Again, it comes back to that narrative of resilience, if not strength, despite what is happening in the Middle East. Now, that 20-odd% growth number for the US, while it is good, is only in line with what we're seeing across the rest of the globe. European earnings growth is likely to be a bit weaker than US earnings growth, and Chinese earnings growth is also likely to be a bit weaker than US earnings growth. But there are a range of other countries that are printing very strong earnings numbers and are likely to print very strong earnings numbers for this full calendar year. South Korea is a case in point, a primary beneficiary of the AI trade at this point. Earnings growth for this calendar year for South Korea is expected to be up 200% relative to last calendar year. And there are also some other cyclical emerging markets, plays on higher commodities, which have also done quite well. If you look, for example, at South Africa and Brazil, both expected to give quite strong earnings growth this year. So it's across the board. It's the US, it's a range of emerging markets, it's a range of cyclical countries. And what we have spoken about over the past couple of months is how global markets appear to be pricing in a combination of faster growth and higher inflation, sort of an expansionary phase rather than stagflation, which would be lower growth and higher inflation. And now we're seeing that sort of argument confirmed by the labor data in the US, the global PMI data, and the earnings data. It would appear that the approach adopted by the market so far has turned out to be correct. And just on those South Korean earnings numbers, they are simply extraordinary. The growth rate in the South Korean earnings expectations is something you will not often see. It's a massive ramp up in earnings expectations over the past couple of months. And year to date, the South Korean stock market in its entirety is now up over 100% in dollars. It's quite remarkable. And finally, shifting to South Africa, like we've seen globally, the South African PMI data is picking up too. And it is quite surprising. You would think that the South African economy would be quite exposed to higher energy prices. And perhaps it's a case of having to wait a bit for the data to filter through. But in the interim, the PMI data in South Africa suggests that growth in Q1 was pretty resilient, and growth in Q2, although it is early days, looks like it was pretty strong as well. But that does come with the obvious risk that inflation is picking up. We've spoken about this before, and it does suggest that the SARB is likely to hike. The market is penciling in 2 rate hikes by the SARB by the end of the year. And that's quite different from what was priced in a few months ago, where the market was expecting 2 rate cuts by year end. So the higher inflation, and with that, the higher interest rates, does pose some risk. But in the interim, South Africa, like the rest of the globe, is proving to be quite resilient. And that's where we're going to end it this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that I reference in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity, Equity Derivatives, Currency Derivatives, Bond Derivatives, and Interest Rate Derivatives markets, an authorized financial services provider and a registered credit provider.